I think it's both. I think the most unknown question for the oil markets for 2019 is a level of demand. So oil, interestingly, is sort of acting more like an equity market in the sense that it's pricing in concerns about future demand. But what the report is confirming is that facts on the ground right now for demand are still quite strong. Demand is strong around the world, but people are really worried about these red flags in China in terms of auto sales coming down, retail sales coming down, and they're looking at that and saying maybe this is a leading indicator that demand might come down in the future. But oil in the past has typically been a spot asset, so trading for supply and demand right now, but it's starting to behave a little bit more in terms of anticipatory for the future.
So as we talk about the price action in the markets, they are forward-looking. And if it is indeed, like you said, oil as a more forward-looking indicator now, what was it about that steep drop between October and December and then the sharp V-shaped rise that we've seen that tells you anything about what's happening with the way that the markets are priced for supply and demand at this point?
It tells you the market is pretty tight. So we were very suddenly able to move from an undersupply situation in the first half of the year to an oversupply situation in the second half of the year. And the key component of that really was U.S. shale. We found out that the American government reports, the weekly inventory reports, were really understating the level of production growth. And that started to become clear in October, which is really when the trajectory of oil prices started to go downward. So when we look at where we were in December of 2017 forecasting the level of production growth, most agencies had less than 1 million barrels a day of production growth coming out of the U.S. We ended up exiting the year at 2 million barrels a day. So the really critical question for 2019 is where is that level of supply growth? We think it's unsustainable at 2 million, but we still think it's going to be robust. Where is that relative to the level of global demand growth? Because that's what's going to determine, amid all the noise, that's what's really going to determine the trajectory for oil prices.
There's no doubt that U.S. shale has been a huge defining force in what's happening with oil markets over the past couple of years. What is your sense about how these production cuts from OPEC and its partners, ROPEC, OPEC plus, whatever you want to call them, how likely are they to stick and be disciplined to those cuts throughout the course of this year?
Well, oil right now, the market is in a transition period, so we're moving from a state of oversupply to more of a balanced market on the supply side. So I think OPEC is really going to do everything they can, led by Saudi Arabia, and it's going to take a while for that to show up in the actual data. Production cuts, export cuts from OPEC doesn't lead to actual inventory drawdowns in the OECD markets for a couple of weeks and months afterwards. Particularly for Russia, it's difficult for them to draw down on production in the winter months. And shale itself is also in a self-correction process right now. We've seen capital programs announced for the new year. Companies are cutting back on their level of spending. So we should see a moderation in the level of growth coming out of the U.S. So at least on the supply side, we are self-correcting. That's why I said earlier, the real question for 2019 is on demand.